Man, do we ever have a lot to talk about. It's been a minute since we last spoke about a couple of the stocks in my portfolio, but with the way the markets have been trending lately, some of these stocks in particular have been on an absolute tear, which we need to address in today's video because quite a few viewers have been asking. Over the past month alone, the Nasdaq 100 has climbed an additional nearly 5%, which is pretty nuts considering the current market ratios, and the S&P 500 has also climbed quite substantially at around 3.5%. And of course, this is positively reflected over into the returns of my portfolio since I hold a number of these low-cost ETFs that track passively managed index funds. What's new, right? But seriously, this is why I tend to suggest these ETFs for most retail investors, because while you're out actively potentially trying to find these big winners like we'll be speaking about in today's video, well, these ETFs are working in the trenches for you, trying to consistently make a return on your invested capital. So anyways, let's just cut right to it. Lightspeed and GoEasy, those are the two stocks that we'll be speaking about in today's video. And as always, my name's Griffin, and this channel is all about making investing both in the stock market and real estate accessible for all levels of investing. And I'd highly encourage that you stick around by subscribing to the channel and liking today's video. All right, so let's just jump right into the first one, and that would be GoEasy, ticker symbol GSY on the TSX. And this stock has done nothing but impress me quarter over quarter as a shareholder. The underlying growth in financials is fantastic, and obviously or unsurprisingly, this has translated over into an appreciating share price. With that said, I did not expect GSY stock to reach the nearly $200 per share range. I'm filming this on Thursday morning. By the time this video is out, potentially it will have busted the $200 per share range. I was expecting this type of growth over most likely a 2-year time frame. In fact, this stock came on my radar somewhat later to the game from the March 2020 lows when it was trading for around the $80 per share range. So at the moment, I'm looking at my own position in GSY up around 150%, which of course I'm extremely ecstatic about, but had this even been on my radar sooner, my gosh, it was trading at below $30 a share back in March 2020, which would represent nearly a 600% gain. Nonetheless, this company has been extremely solid financially, and that's why investors have been buying into GoEasy quite consistently over the past year and a half. But in the last month alone, the stock has appreciated by around 14%, which is quite a bit. And so for this reason, considering this level of excitement, of course, let's go ahead and take a look at some facts and whether or not I'm going to be buying, holding my position, or even selling some off. So GoEasy did release their Q2 fiscal quarter results around a month ago now, and overall across the board, a fantastic quarter for the company. GSY's revenues just exceeded 200 million for the first time ever, up 34% year over year, and their net income was up 50%, which is absolutely insane considering that this is also their 80th consecutive quarter of positive net income. During the quarter, GoEasy also acquired LendCare Holdings, all of which contributed to a record $379 million in total loan originations, up 122% compared to the same quarter of last year. Another interesting point is that their net charge-off rate, meaning the amount of money that the company expects to possibly not get paid back from certain borrowers, has dropped down to 8.2% from 10%. Let's remember that GoEasy is an alternative lending company, and so for this reason, there will inevitably be some loans that they do not get paid back. But seeing this figure drop down is definitely positive to see. So yeah, for an alternative lending company, GoEasy hit the mark on every point that you'd ultimately like to see growth and improvement in. With that said, this aggressive growth in share value over the past month since they released their most recent earnings has obviously resulted in increasing relative values for their financial ratios. Starting with the price to earnings ratio, this value has been steadily climbing since April to a point where it's nearly doubled and approaching a range where historically over the past 5 years at least has struggled to maintain. Now, this is not to say that the stock won't continue to climb up until next earnings or reach, say, a 19 PE, but it's definitely something to consider that it's approaching an upper value range where it's had a hard time maintaining. Now, based on analyst estimates for financial growth, GoEasy is expected to continue posting increasingly large top-line figures over the coming 2 years, and then depending on the source, some estimates are saying continued growth in earnings per share. Based on their most recent track record though, over the past couple of years, I tend to think that GoEasy goeasy is going to continue posting increasingly large net income figures over the coming year, especially with the new acquisitions that they've done most recently and the momentum that they've managed to gather in this past fiscal. And the fact that currently interest rates are still quite low, however, over the next 2 to 3 years will most likely start incrementally increasing, is going to actually be also beneficial for goeasy's lending part of their business. So realistically, where do I stand with GSY? Well, honestly, I was not expecting the stock to reach the $200 per share level until at least mid 2022. That's what I was sort of expecting here, but obviously that has exceeded expectations. And so at this point, well, around a month and a half ago, I did bolster my position a little bit. Turned out to be a pretty good decision, but right now, with the company's underlying ratios having significantly shot up in value, I'm not really going to be bolstering my position right now until at least next earnings. At this point, the stock has run up substantially over the past year that I've been invested in GSY, but investor expectations overall are extremely high. GSY still remains one of my favorite stocks, but I think it's being slightly overbought, and until I see some more positive news or earnings come out, I'll just be sticking with my current position. I won't be trimming my position though, because even though in the short term we may see some higher levels of volatility, potentially even loss in share value over the coming quarters, well, this is still a company that I see outperforming the market in the mid to longer term. All right, moving on to stock number 2 that has been seeing some unreal price movements lately. Some could even say Lightspeed movements. We have Lightspeed Commerce, ticker symbol LSPD, both on the NYSE and the Toronto Stock Exchange, which actually recently changed names from Lightspeed POS, which stood for point of sale, to now Lightspeed Commerce. Regarding that name change, actually, Dax De Silva, the CEO of Lightspeed, said that in light of the company's current full scope of solutions, the company isn't exclusively a POS provider anymore. Rather, they aim to be a one-stop e-commerce solution. And I think that this is actually a good thing, not really about the name change per se, but that indeed they are focusing on a multifaceted approach to e-commerce as well as in-shop solutions. Now, Lightspeed is one of my top performing stocks, having more than tripled my initial investment over the past year and a half. And considering all of this, I've had an unreal amount of viewers reach out requesting an update on Lightspeed. So let's get right into it. Before market open on September 2nd, the stock is currently trading for $145 per share on the Canadian markets, meaning that in the past month alone, it has appreciated by over 30%. And that to me is somewhat problematic right off the bat. I definitely like it, but that's still an orange flag for sustainability. Over the past year, Lightspeed had reached an all-time high of right around $102 per share back in February, where it then sold off consistently for around 3 months by roughly 35%, which is quite substantial. But since then, it would appear that investor outlook for Lightspeed has significantly turned around, appreciating by now over 100% in the span of about 4 months. So yes, the company's growth in top line has been insane, but let's first address the fact that Lightspeed is one of these companies that is fueling this growth through share dilution over the past year, which has been quite substantial. Over the past year, the total number of shares out in circulation for LSPD has increased by more than 50%. As a shareholder, it's just important to realize that from a relative value standpoint, this is pretty much the exact same thing as the Federal Reserve increasing the money supply by 50% in that same 1-year time frame. So basically, this is going to increase the amount of inflation that we'll be seeing over the next year. That's in terms of the money supply, but sort of applies in the same way to a company significantly diluting their shareholders by increasing the amount of shares out in circulation. The relative value of each share that you hold decreases. In parallel to this, over the past year, the company has been using this cash to just overall fuel their growth, enter new markets, and then also acquire other subsidiary companies. We can see this trend quite evidently when taking a look at their financial growth figures over the past year, right? So fantastic top line growth and consistent massive losses though in earnings, which isn't out of the ordinary for a company like Lightspeed. This is something that we did see for a long time with Shopify, for example, but it makes it very difficult to have any sort of actual price target for a company such as this one. And for this reason, Lightspeed's a company that's extremely hard to accurately value and have any sort of price estimate or target for. This is pretty much just a bet on future growth at this point, as with most hyper growth stocks in the tech space that are just burning through monumental amounts of cash. Now, in terms of growth though, they did have a pretty fantastic recently reported quarter, which was announced on August 5th. So total revenues were 115.9 million, an increase of 220%. Recurring subscription revenue just shy of 50 million, which is also an increase of over 100%. And then their transaction-based revenue was 56.5 million, which is an increase of over 450%. That right there is what I like to see though for a company such as this one, where they are focusing a lot more on their payment gateway and creating income through each transaction flowing through their platform. But as mentioned, burning through incredible amounts of cash. So their net loss was 49.3 million as compared to a net loss of 20.1 million. And based on future growth estimates for Lightspeed, we're seeing this trend actually continue, where top line is going to continue growing most likely by around 30% annually, while losses will even dip further before gradually recovering towards profitability by 2024, but actually turning into the black from an earnings standpoint is still not on the horizon. With that said, even just from a sales standpoint, the stock has become relatively more expensive over the past couple of months, where the price to sales ratio is the highest it's ever been, having just surpassed its previous highest point in February, just before that sell-off. So all of this leads me to the consensus for Lightspeed that over the past year and a half that I've been a shareholder, the stock has more than tripled in value, which I'm absolutely ecstatic about. However, at the current price point, I just think that it's been somewhat overbought and investor excitement is extremely high. So for me, seeing myself purchasing Lightspeed stock at this current price point and relative value, where even though we don't even have a PE to base ourselves off of, the PS ratio is extremely high right now. This is just not something necessarily that I'm comfortable with. In fact, I'm even going to be selling off my cost basis that I initially created around a year ago. So that's something that I like to do with stocks where I've seen incredible amounts of appreciation, where I sell off my cost basis and then I'm purely in profits. The reality is that this stock is extremely expensive right now. Investor expectations are high. The company's underlying relative value ratios are also increasing quite a bit. And then also they have been just significantly diluting shareholders over the past year, most recently around 7.7 million shares in the last month. So yeah, at this price point, I just think that covering my cost basis is something that's wise to do. And I see nothing wrong with doing so. So that pretty much wraps it up though on today's update on two stocks that I hold in my portfolio that have appreciated substantially over the past month and a half since earnings. Let me know down in the comments what you think about Lightspeed as well as Go Easy, whether or not you think at the current price point you should be buying more, holding, or selling off some shares. Let me know down in the comments. And as always, if you want to learn more about stock market investing, make sure to check out all the other videos on my channel and also subscribe and hit the bell button to be notified of new and upcoming investing content. Also, if you're newer to stock market investing and you want to learn everything necessary to properly navigate the stock market, make decisions on your own, and create a portfolio crafted for your needs as an investor, make sure to check out my full stock market investing course. There's a link down below. So on that note, thanks a lot for watching today's video, and I will see you in the next one.